2015 is here. It's a time for new beginnings and resolutions. Now don't worry, I'm not asking you to lose weight. What I mean are financial resolutions. One that will not just help you create a tidy nest egg, but actually build wealth. Hello and welcome. You're watching Money, Money, Money. I'm Sumera Abdi. Well, beginning something new is often the most challenging part. But as they say, well begun is half done. Wealth is not earned, it has to be created. Therefore, it's not enough that you invest whatever is surplus. The first financial resolution of 2015 should be to carve out the investable corpus from your monthly inflow after budgeting for basic expenses and before accounting for luxury spends.
In terms of resolutions, our suggestions would be: one, keep a resolution to save more and keep a target, 10,000 rupees, 20,000 rupees per month. Keep a specific target that I'm going to save more this year, month on month.
Okay, so you've set aside money. But how do you put it to good use?
Simple data points like SIP of rupees 1,000 every year in one of the best performing diversified equity mutual funds would have given you a CAGR of 21%. That's an annual compounded return of 21%. So you do not need to do something that is complex, something you do not understand, something that is locked in. Just plainly keep it simple. For me, that's a very crucial point of making investment decisions for the new year.
Would you rather take 10,000 rupees every day for 30 days or a rupee which doubled in value every day for the same period? If you pick 10,000 rupees every day, you've made a very poor choice indeed, because this means that you have only 3 lakhs at the end of the month. Had you picked a penny which doubled in value every day for the same period, you would have been sitting on a pile that read almost 50 lakhs. Well, that is the true power of compounding. But do remember, without proper goals, all of this can easily go off track.
One of the best ways of investing money is to have your goals. So each one of us have goals. There are goals that you want to achieve in short term, medium term and long term. So the process that needs to be followed is that you define your goals, assign a time horizon and assign a target. This really helps you in terms of deciding which asset class you should invest in. Now, for example, when you're investing for the short term, your focus should be on safety of capital. So you go into debt products. When you're investing for the long term, then your focus should be to beat inflation. So you invest in equity. So you must establish all your goals. So all those investors who have not been following this approach, my advice would be they should try and align all their investment to their goals. And also important thing is to create a separate portfolio for each of the goals. And why it is important is because many a time we've seen investor creating one portfolio, and as and when they require money, they keep taking out, and they realize after some time that they don't have enough money for their own retirement, or they don't have money for some other goal. So it's important to follow a goal-based approach and also make sure that there is a separate portfolio for each of the goals.
Well, Hemant is right, and we just cannot emphasize it enough. Goals don't have to be just big ones like buying a house. If you want to buy a car, go on a vacation, or send your kids off to college, all of those could be individual goals that need to be treated individually. So if you haven't already taken the goal-based approach to investing, you have got to start now. And it's not going to be easy, but then nothing that's worthwhile is ever easy. You have to be patient. And in the new year, there's nothing that's going to test your patience like the equity market.
It's not about timing the market, but time you spend in the market. So consider it like not playing a game of T20 cricket, more of a test match. You do not have to hit every ball that is bowled at you. You have enough time to spot the opportunities and select. Just to give you some data points, 10 years back, 1st of January 2005, Nifty was at 2,100, Sensex was 6,700. Nifty and Sensex have grown 4x in 10 years. Simple strategy, but of patience, not to take those calls. And we've been through volatility, we've been through crises, so just being patient with the market.
And in return for your patience, it's only natural to expect that you get some generous returns. So what is it that keeps going wrong?
Most investors focus on gross return when they analyze their investment. You must have heard people talking about, okay, I'm going to get 8% return or 10% return. What they do not realize is that gross return is only one aspect. You have to pay tax on that, and there is also inflation which you have to take care of. So many times what we see is the net return that they get, or the net real rate of return that they get, is actually negative. So I think it's important for investors to realize that they need to create a portfolio in a manner that, especially when they're investing for the long term, that they actually earn positive real rate of return. Otherwise, imagine what will happen is, even if you're investing for 20-25 years, there will be a situation where you realize that your money has just grown in numbers and not in value.
Now that doesn't mean that you become paranoid, or does it?
How not to lose money is as important, actually more important than how to make money. Anything that goes down 50% has to come up again 100% for you to even up on that investment. So stay away from anything that is complex, unregulated, something that you do not understand. Build protection, build a contingency fund. Most investors that we speak with do not have a plan for an emergency. Do you have a plan? Do you have your liquid assets, which are at least 10% of your net worth? Do you measure your obligations? Your obligation should be ideally less than 40% of your income. You need to be able to build protection. You need to think about concepts like, do I need a will? Do I need to inform my friends, family, relatives? Do I need to create a nomination or a beneficial ownership in all the investments that I own? These are simple steps, but being paranoid sometimes is a great strategy.
And don't forget your loans.
Pay down your debts, especially the high cost debt like credit card debt, like personal loans. Pay down those debts.
Well, that's right. In the tug of war between debt and investments, it's debt that must be prioritized. Well, you have to try and pay off your debt, or at least the bulk of your debt, before you start planning your future investments. So dwell on that. We'll take a very quick break. When we come back, what do you do with insurance? Is insurance actually a part of your investment planning? All of that and more when we return. Stay tuned. Welcome back. You're with Money, Money, Money. As we step into a new year, a time for new beginnings is also a time to make resolutions. Now, I'm sure many of you would have made New Year resolutions, but how many of you have actually made financial resolutions? Now, I know many of you would have thought in 2015, I'm going to do my taxes on time. But trust me, there is always more that needs to be done. So as we step into 2015, let's resolve to have better investment habits. And when I say investments, I don't mean savings.
Well, there is nothing wrong when you look for safety in your investment process. After all, it's a question of investing your hard-earned money. You don't want to take undue risk. But I think what they fail to understand is that when you invest for the long term, inflation is a much bigger risk than risk of losing capital. I mean, you will not see a portfolio where you invest for 10-15 years in equity where you have lost money. So I think it's important for them to understand that they need to start looking beyond traditional options. Yes, by all means, look at safety, but then start looking at market-linked product. Within that, for example, if you look at mutual fund, in the debt, there are a variety of funds which are available. There are liquid funds, there are short-term funds, there are income funds. So depending on your time horizon and the kind of risk you want to take, you should be selecting these funds. And in the long term, again, you look at equity as an asset class, but don't make your portfolio very, very aggressive by investing, predominantly in mid-cap funds or sectoral funds. Go for well-diversified funds. So I think it's time for investors to start looking beyond the traditional plans. Make sure they have enough money at every stage of their life.
And how do you know when you have enough money?
Every year when you begin, measure up your assets, measure up your liabilities, know what your net worth is. It will go a long way in helping you plan your savings, plan your investments, and going for those milestones. As you build the financial plan, what are your milestones? What are the lifetime events that you need to fund for? What are the saving habits that you need to change? What are the spending habits you need to change? So it's always a great strategy to calculate your net worth, build a financial plan, and find ways and means to achieve them.
Alright, so you've made your investments, you've calculated your net worth, and you're probably wondering what happened to insurance. Well, insurance has very often been confused with investment. So take a pledge with me, never ever to actually buy insurance in the hope of getting good returns. An insurance policy is a pure risk cover. It's not a way to stash enough cash to buy a car.
Every investor must ensure that they have taken the right insurance product and they have separated the insurance from investment. So they should not be really focusing on traditional plans. It's very common to see investors having 20, 30 and even 40 insurance plans. I think they need to understand that it's not about having the number of insurance plans, but it's also the quantum of insurance plans. So the first aspect has to be life insurance. The second is health insurance. Now again, the quantum has to be right and the type of policy that you take has to be right. So if it is a young family, a small family, they should go for a floater health plan. But if there are senior citizens in the family, then they should go for individual plans for them.
And remember, just planning your investments right is not the end of the road.
Once you've got the portfolio strategy right, your investment strategy right, your financial plan right, consult someone who's a financial doctor, who's an advisor to you, who can give you step-by-step approach in building a model portfolio, an investment portfolio. Review this versus your objectives every month. See how your asset allocation is, see how your concentration is, how your liquidity position is, and does it match up to what you started with in the first place. If not, go back. And finally, do not get sentimental about your investments. Investments are supposed to generate returns given a measure of risk. If they don't add up, you need to exit, cut your losses. Do not get married to your investments.
Okay, so let's assume for a moment that you've invested and you've insured. Is there anything more you can do in 2015?
The government does not have enough resources to cover all the poverty needs that India has. So even very small amounts, whatever you can afford, please go and give some money for charity, for worthy causes. That will give you a lot of contentment, that will give you a lot of satisfaction.
Now the thing with New Year resolutions is that they're often broken as soon as they're made. Now I've made a lot of New Year resolutions and I've also broken a lot of New Year resolutions. But don't worry, there could be hope yet.
Research has shown that financial New Year resolutions tend to be followed much more committedly than the normal New Year resolutions like what all of us have in the sense of losing weight, spending more time with family, etc. Financial resolutions somehow we tend to go and deliver on much more in a much more committed manner.
Alright, there are enough and more indications of things going right if you have planned right. And I hope the only reason you've not made a financial resolution for 2015 is because you were waiting to finish watching this show. Well, get to work already. We'll slip into a very quick break. When we return, we'll rewind 2014 and get you some of the best advice from our experts over the year. Stay tuned.